Okay, so welcome to today's class, everybody, once again. And so today, like we know, is the second day of the 8 days training. So I hope you cannot hear me now. Can we all hear me now? Please confirm if you can hear me now. So today is the second day rather. And today we're going to look at the basics of the Forex market. But before we do that, we are going to take ourselves through the process of setting up the brokerage account. We're going to see how you can go through your brokerage dashboard, your Greenwave Exchange dashboard. All right. So that's the first thing we're going to do quickly. Then we'll now look at the basics of the Forex markets, and then we'll now go to question and answer. Okay. So, like, we're going to want to take things gradually. We don't want to waste, we don't want to rush things, and also we don't want to waste time. Okay. So let me share my browser with you guys. So now I'm going to go to Greenwave. So the website is greenwavex, all right, .com. So when you get to greenwavex.com, if you don't have an account yet, you click on register. So when you click on register here, okay. Yesterday we talked about the essence of having a brokerage account. You need to have a brokerage account as a retail trader to be able to participate, or else you won't have access to the market because the market is very huge. And so you put your detail here, and then you agree to the terms and conditions and click on register. When you do that, you're going to get a login detail. So click on login. The detail is going to be in your email address. Put it here. Let me use this one. And then you click on login. Okay, let me use this one. I think this one. So then you find yourself in here in your dashboard. Okay. My network is quite slow today because if your network is fast, the Greenwave Exchange dashboard is very, very light. So if your network is good, it will just load very, very quickly. So this is the dashboard. Let's look at it very, very quickly. And you have my account. These are the different accounts here. Okay, so I have this, I have another account. I've not really deposited anything in this one. So there are two, you can add other accounts. Okay. So there are two major platforms when you want to trade with Greenwave Exchange. We have the MetaTrader 4, and then we have the web platform. So that is where the business is done. We're going to spend time, okay, maybe 30 minutes to 45 minutes on this platform, but that's not going to be today. And then you're going to see the difference between the MetaTrader 4 and the web platform. MetaTrader 4, you can download it, okay, on your PC. You can even have the soft version, the mobile version on your phone. Web platform also, that one is more of web based, but it's actually you guys are gonna see the difference. Okay, there is a particular there's a particular stuff on this web platform that can give you trade ideas and all of that. Okay, but like I said before, we're going to talk about, we're not looking at the trading platform now. So if you want to add another account, you just click on add accounts, and then you choose whether it's web platform you want to use or the MetaTrader 4. MetaTrader 4 web platform. Then you choose your currency is going to be in USD. But I was told today that the Naira account will also be available, okay, very soon. So you guys can also fund the Naira. But I'll give you more information about that. You put your password, the password I used to log in here, and then you click add. You do that, you're going to have another account. So you can have many accounts, okay? You can have many accounts. So you can change the name of your account. Put whatever name you want in there. I make this one, give it my name. All right, I can put another name here. So if you are trading for, let's say, for a fund manager, you're trading for like 3-4 people, just put their name with this their account. So this is what you're now going to use to log in into the MetaTrader 4. We're going to talk about that later. Okay, so once you get in here, even before you click add account, the first thing you should do is to click on documents. Okay, so it's very, very important that you upload your documents. This is a very, very big business. Just like I said yesterday, that the government does not joke with the financial market, because if there are loopholes, we have people who might want to use it to do money laundering and all that. Okay, they will fund account here, withdraw from it, and all those kind of stuff. So the government want to make sure that the people that are doing this kind of business are people that can be known. All right. So this document we are trying to ask you to submit, it's not because we actually wanted to. Okay, yes, we wanted to, we'll have done that also. Okay, the brokerage will have also done that also, but it's a compulsory thing, okay, from the regulatory bodies. All right. So like I said yesterday, Forex is a very regulated business. So the regulatory bodies enforce brokers to make sure they get this information. The first one is your identity, which can be your passport or your driving license. It could also be your voter's card. All right, any government licensed ID card. So you click on add file and upload it. And then so you can add file. Okay. Okay, this one here, the second one, sorry, the second is proof of residence. Okay, to prove that your residence actually. So this one could be your statement of account, that's the bank statement, or any other utility bill that bears your name, okay, and the address that you used to register here. And so you click on add file, and then once you do that, your the back end guys, they are going to verify your account, okay, when they discover that the document is good. And after that, the next thing you're going to do is to go to your account status. Okay, before I go there, now let me also say that you don't necessarily have to do this before you start trading. Okay, if your documents are not ready, that won't stop you from trading. So you can be trading and then search for the documents. Okay, but I advise you that you get the documents ready, because the document will be needed, okay, for you to withdraw your fund. So you won't be able to withdraw your fund if you don't have the documents. Okay, so I advise you have the document. Okay, but if you are sure that you have the document, maybe there's a little delay, or you are looking for it and you want to start trading. Okay, it's all okay. You can start trading without having the document. Okay, so next thing, you go to account status, or you go to personal data. That is personal data. You now give the company some of your details, like your name, your state of birth, your birthplace, your mail, all those stuffs. All right. You want to change your password, because the one you register with, maybe if you're not okay with it, you can just change it. Put the old password here, put the new one, confirm it, and then click on submit. Okay, so that's that about that. Now, if you want to deposit money to your account, you click on deposit here, and then you're going to see the different options that are here. Fund using cryptos, you can fund using your credit card, you can fund by transferring money to the company's account number. You can see the account details here. And this one is, of course, crypto. This is the what do you call it now? This is the wallet. Okay, the wallet address, TRC. Make sure it's TRC if you are sending a USDT. Okay. So that's it. So that's just I think that's what you need to do. I don't want us to waste so much time here. And then for you to download the MetaTrader 4, you can click here if you want to download the MetaTrader 4, but we'll still come back to it. No need to be in a hurry. Okay, so that's how you set up your account. Make sure you set up your brokerage account. It's really, really very important that you do so. Okay, so let's now go back to our slide. Please make sure you, whatever question that you have, please make sure you drop it for me, okay, while I'm talking. And if I can't answer immediately, then I will look at it at the end of the class. Okay, if it's proper that way. Okay, so I'm going to take us, we already did some things. We looked at the financial market. We broke everything down, look at some examples, look at different asset classes, examples under them. We look at how you can trade the financial market. You can either buy and hold, or you can trade the contract, CFDs. Okay. And we talked about the things that you need, okay, to start trading. All right. I will mention brokerage account as one of them. So, which we already talked about that now. Okay. So, trading capital, that one is left to you. All right. And then this education analysis, also some of the things we're going to help you with. Okay. Now, so let's start with the Forex market. We're starting with the Forex market. So when we say the Forex market, we are saying the meaning of Forex is foreign exchange, okay? And they have to do with, the Forex market has to do with currencies. So yesterday we talked about the globalization of the world, whereby if you are going to another man's country or another woman's country, you would have to exchange your local currency to the one that they have over there, all right? So that you'll be able to do whatever you want to do there. Okay. So because of that, there is a need for an acceptable, a globally acceptable exchange rate system. Okay. That let us to know which currency has more value than the other and all that. So that's supposed to be, there's an exchange rate, okay, for one currency against the other. All right. Yeah. So like you want to go to the bureau de change, you have some, you guys understand what I'm talking about, right? You have some dollar you want to change to naira, you have naira you want to buy dollar and all that. So you go to the bureau de change, the man or the woman has the price is willing to buy, the price is willing to sell to you. If you want to buy, it will give you his selling price. If you want to sell, it will give you his buying price. And one thing you'll notice is that the buying price and the selling price, they are always different. Okay. And if I ask you why is it that the buying price and the selling price are always different? Let me ask you guys. And if they are different, which one do you think is bigger than the other one? Okay. So that's a question for you guys. Please answer. Why do we have different prices for buying price and selling price? Okay, from the bureau de change guys. Okay, why? And which of these prices do you think is bigger than the other one? Okay. So let me get the response quickly. Okay, so let me why you drop those responses for me? Let me. Okay, so I have Larry Kazim say the selling price is bigger. Yeah, that means his selling price is bigger than his buying price. And why? Why is it so? The prices are different because of profit purposes. Yeah, thank you. That's from SN. Yeah, the man wants to make, or the woman at the brokerage wants to make money. They want to make money. So that's why whenever he sells to you, he sells at the higher price from the price he's buying from you. In fact, if you buy at a particular rate, now, the transaction has been done. And let's say 5 minutes after you want to sell it, it's going to give you a different price, a lower price. Okay, so that's it. So the difference in price is what makes him to have his money. So you not multiply that difference by the number of units. If it is $100, if it is $200, if it is $1,000, so that's the number of units. And so that's what is now going to determine how much is making. If this difference is 5 naira and you are doing $1,000, okay, so that means it's going to make 5,000 naira on that transaction. Okay, so a local currency speculator who after investigation believes that its local currency will drop in value against the dollar. Let's say as a guy now or as a woman who understand what is going on in the country, and then you, after some investigation, you discover that the dollar is going to lose value. I mean, the naira is going to lose value against the naira. If the rate is currently 500 and you analyze that it's going to become 550 later, one of the things you could do is to buy some some of these things, excuse me. Um, okay. Taking my light, so I have to change to my alternative power system. Okay, so thank you very much. Okay, so if you are what was I saying? Okay, you discovered that you investigated that the price, the 500 naira exchange rate is going to become 550. So what you can do is to buy some dollar. You can just, if you have 500,000 naira, you can just go to this product change and then exchange it to $1,000. All right. And when the price now gets to like 550, so you just go and sell it, and then you have 550,000. So you make 50,000 this difference. What have you done there? You have done what Forex traders do. That's just what Forex traders do. They take advantage of changing exchange rates of one currency to the other. Okay. So that's what we're going to be doing there. But in this case, you're not going to be going to the bureau de change, because you're going to the bureau de change, you have to take some time to go there. It might even take you 30 minutes, 1 hour before you could do all the transaction. It might even be up to 2 hours, okay, before you go back to your house. Okay. But here, in the market we're talking about, the online Forex market, it's very, very easy. In a matter of less than a second. Yes, it happens quickly. Transaction is very, very quick. Okay. So through a broker. All right. So that is what we now call speculation. So what we are trying to do here is to speculate. So speculation is you trying to make money from price fluctuation, okay, from exchange rate changes, because the exchange rate is always changing. It can go up, it can go down, small, small, or big, big, stuff like that. So you taking advantage of that is what we call speculation, and you can make a whole lot of money from that. So that's the Forex market. And the Forex market is the biggest in the world because it involves so many countries, right? It involves so many countries. And it's a very, very important market. You can see sometimes the Central Bank of Nigeria, they make some policies to protect the naira and all that. Sometimes the things they do can affect the naira and all that. So the Forex market is something not to joke with at all. Okay, they don't play with it. So it's very big, it's very liquid, it's very massive, it's global, it's done on the internet. And guys, let's go on. So now, how are these currencies traded? How do we trade these currencies? Okay, currencies are traded in pairs in the Forex spot market. FX, that's Forex. Okay, they are traded in pairs. When we say pair, we're talking about two. So what you're trying to do is to trade one currency against another one. All right, just like the case of the naira and the dollar. The naira and the dollar, you going to the bureau de change to exchange your dollar for naira. What have you done there? You have done performed the Forex transaction. You have traded a currency pair. Okay, you have traded a currency pair. Okay, because it has to be, you can't just go and say you want to exchange naira for naira, okay, or dollar for dollar. It has to be one currency against the other. So they are traded in pairs. So let's look at an example. An example of such currency is euro dollar. Okay, so this is how we're going to talk more. We're going to talk later. We're going to talk about this symbol here. So this one is euro. Euro is the first currency, and the United States dollar is the second one. Now, this is a currency pair. Now, this pair alone is a market on its own. So this is the euro US dollar Forex market. Okay, and it has an exchange rate at every point in time that is fluctuating, that is changing, increasing or decreasing every time the market is open. Okay, so let's look at let's say you bought 1,000 units of euro US dollar, and at the time that you bought it, the exchange rate was 1.1255, which means $1 125 $1.1255 rather. So the value of the transaction is going to be, of course, if this is the exchange rate and you are buying 1,000 units, you multiply, right? So this is the value of the transaction. And when you buy, you're buying in anticipation that the euro is going to rise against the dollar, or you're buying in anticipation that the currency pair, this market, the exchange rate is going to increase. Okay, if the exchange rate is going to increase, it's either the euro gains value against the dollar or the dollar loses value against the euro. Okay, that's what is going to move the euro US dollar up. And then you can take advantage of that. So let's say this was the price that you bought. And let's say the currency pair now rises from 1.1255 to 1.1300. So what will be the new value? This is going to be the new value, which means that you would have made some profit there. Okay, we're going to talk about profit and all those things later. I'm just trying to paint a picture, okay, of how the market works. Okay, so if the currency pair rises to this, this is the new value, and then you would have made some profit there. So likewise, when you're selling 1,000 units, you analyze that the exchange rate is going to drop. So what you're going to do is to sell. Just like we said yesterday, that in CFD spot market, you can buy or sell a particular instrument. So if the price is going to go up, you buy. If it's going to go down, you sell. Okay, so in this case, we analyze, or it's been analyzed by the trader, that the price is going to go down and it's sold. So if euro US dollar eventually drops, the trader will make profit. Okay, which is going to be like the price difference that's between the buying and the selling price, or between the initial price that is sold and then the final price is getting out. So the difference multiplied by the unit of the transaction, which is 1,000 units, is 10,000 units, and all that. So that's how the profit is going to look like. Okay. So that's it, guys. So that's just the basic of the whole thing. We're going to really go very, very much in detail. We're going to explain the different terminologies that you need to know, some key terms that you need to understand very well before you can say you are a forex trader. Okay. So in this example, we use the euro US dollar currency pair. Okay. The euro is called the base currency. So the first currency of the pair is called base currency, while the USD, which is the United States dollar, is called the quote currency or the counter currency. So this is a term now. So next time I might say base currency, counter currency. Now you know what it means, right? So the first currency of a currency pair is the base, while the second one of a currency pair is the quote or counter currency. Okay, and it's always equal to the exchange rate at every point in time. Okay, which is always changing. All right. So now a lot of people get engaged in the forex market because the forex market can be really, really very lucrative. Can be lucrative in the sense that, let's say you invest $50 on a particular trade, you have the potential of making multiples of what you are risking. Okay. Yeah. It's not every business that can do that. And you can get that in a matter of minutes, hours, or days. Okay. Many of us in our various businesses, when you invest money into a business, what do you think is the ROI of an average business over a period of 6 months? How many business can give you 100% return on investment after like 6 months? How many? 100% after 6 months? They are not many. They are very, very few. Okay, they are very, very few. But in the forex market, you can double, triple, quadruple the risk, the money you are risking on a particular trade. So let's say I want to buy euro US dollar after doing some analysis, and I now invested, let's say $50, okay, out of my capital to trade that particular, to get myself involved in that trade. If I invest $50, or let me say I risk $50, I could make more. Okay, what I could make from that is unlimited. I could make $100, $200, $300, $500, $1,000 from it. Okay, depending on some factors we are going to look at later. Okay, so that's why we see the forex market is very lucrative. All right. And so why is it very lucrative like that? The reason why it's lucrative is because of leverage. Okay, that's the reason why you could make multiples of your risk money, okay, of what you're risking on a particular trade or on a set of trades. Okay, so when we talk about leverage, I explained leverage to us yesterday, right? I explained leverage to us yesterday. Let me explain that principle. We're still going to talk about leverage in detail later. Let me just give us that concept again. So you have a business that you want to do. In fact, every businessman uses leverage. I don't know any businessman that doesn't use leverage. Let's say you have a business you want to do, all right? And or let's say there are two people. We have two people. So let's give them name. We have Mr. A, and then you have Mrs. B. So the two of them, they want to invest into a business, and let's say they understand the business very well, they are professional in it, and let's say the business comes with a guarantee. Let's say the business comes with a guarantee of like 100% return after like 6 months, for example. So which means that this business, when you invest into it, you can get 100% return after 6 months. I'm just giving us an instance, right? So that's the potential ROI, okay, for this. Let me put potential ROI, all right, for this business. Okay, I didn't finish that. 100% in 6 months. That's the potential ROI for this business, all right? Let me put it here. Okay, so A has, let's say the two of them, let's say the two of them have 50,000 to invest in the business. A has 50,000 and B has 50,000 as capital, 50,000 naira. Okay, so that's their capital, the two of them. Okay, so let me put it here, the capital. And so they now decide to make decisions. Okay, because they know that certainly the business is going to yield 100%. Okay, let's say that's the situation here. This is the capital for this man. This is the capital for this man. So let's now look at what Mr. A did. All right. Let's say Mr. A now invested the whole of the 50,000, invested all of the 50,000. And so now if you invest all of 50,000, that means it's not doing anything complicated. It's just being very, very simple, which is a good thing. And so after like 6 months, after like 6 months, how much do you think Mr. A will have made altogether? Okay, can you guys give me some answers? How much do you think this 50,000 will have become 100,000? Do you agree with me? Yes, it will have become 100,000 naira. Okay, and what do you think is his ROI? What is his ROI? Return on investment is what? 100%. Okay, which is good, which means that he's able, the ROI is already 100%, and he was able to maximize it with the money that he has with him. All right. But let's look at Mr. B. Let's say Mr. B want to make use of leverage, okay, which is what every rich person in the world does. When you see rich people want to invest in the business, they don't usually use their money, or let me say they don't use only their money. They use other people's money. They use money from the banks to make extra profit for themselves, okay, to magnify their profit potential. So let's now say this man, instead, he went to the bank to borrow, let's say, went to borrow 1 million naira because it was really quite certain that the business was not going to be good. Now, this is a case scenario. Okay, if it's that the business is guaranteed 100%. Okay, I'm not saying this is what somebody should do. Okay, I'm not saying, I'm not advising this, that somebody will have to borrow money in the bank to trade, or I'm not advising that. I'm just giving us how leverage works. And this is just a typical business. Okay. So let's say the man gets a loan, okay, from the bank, a loan of 1 million naira. And then the bank says, you know, you have to give us a collateral. Let's say they say the bank says you are going to give us a collateral of um 100,000 naira, and then we're also going to charge you an interest of 20%, okay, on this loan, okay, 20% on this loan. So let's go. Because now the man knows that if he gets a loan of 1 million and the bank charge 20%, that's 200,000, and they also take 100,000 as whatever, as refundable collateral, which is going to be like 300,000 altogether. That's about 30%. So he's still, if he's able to make 100% of that money, he's going to get his money back, right? So he thought about that. Said, well, it's a good deal. Let me go with this. And so he got the loan 1 million, and bank interest. Okay, let me use this. Bank interest is equal to, let's say, 20%, okay, which is 200,000 naira. All right. And they say he has to drop collateral of how much? Of 100,000. And now he doesn't have 100,000, right? Let's say now, it now goes to his friend. Let's say now he borrowed 50,000 naira from his friend, right? To make up for the 50,000 that he has, and then to be able to pay to the bank. Okay. So let's say the friend says, I'm going to collect, just for example, let's say the friend says, I'm going to collect an interest. Okay. And he says, okay, 20,000 naira, or let's say 25,000 naira. All right. So that means all the money that he needs to return now is going to be equal to the bank 1 million naira. Okay, plus the interest 200,000. If he's able to return the money, they're going to give him back his collateral, which is 100,000 naira, right? And then he's going to pay his friend, which is plus 50,000 naira. Okay, 75 now with the interest. Okay, so everything that he now needs to pay back, okay, it's going to be like, when you add all of these things together, that's going to be 1,375,000. That's how much he needs to pay back. 375,000. Okay. So if you even subtract the 50,000 that he already has with him, so that's going to be equal to what? 1 million, 1,370,000. That's how much he needs to return. Okay. So you can see that his own is more sophisticated than this one. Okay. So because he's making use of leverage. So at the end of everything, he's able to invest the money, and now he got how much back? Let's say he got 100%, and then he was able to get back let's say principal. Okay, after business. How much he has after business is, of course, 2 million, right? So that as how much he has after business. Okay, but he needs to remove how much? 1,000. You need to repay, you need to pay those debts. So if he does that, how much does he have left? He's going to have 630,000, right? 630,000 naira. That's how much he's going to have left. And that's now going to be his own profit. Okay. Look at his profit there. He's making a profit of 630,000 naira. Okay, which is going to be, if we change that to some percentage basis, so we can say his capital is 50,000 divided by the okay, let me show you guys. So the profit that he made, the profit he made is going to be like you invested 50,000, it's getting 630,000. So he's making as 600 um 630 minus 50,000. That's going to be like 580,000, right? So that's how much he's making profit after everything. Okay, that's his net profit. Now this guy made just 50,000, and this one made 580,000 naira. So if you put that in percentage, that's going to be 580,000 divided by 50,000 times 100. So that's like okay, didn't do that well. 580,000 divided by 60, 50,000 rather. Okay, that's going to be 1,160% ROI. So you can see that this, all the thing he did is what we call leverage. Leverage simply means borrowed money. That's what leverage means. It means borrowed money. Okay, it means borrowed money. So when you use borrowed money or loan to do a business, it helps you to magnify your profit. Of course, it can also magnify your risk as well, because let's imagine the business doesn't work out as they anticipate. It will be owing a whole lot of money, right? But if it works out, this is what is going to make 1,160% return on investment. Now, that is one of the reasons. In fact, that is the major reason why the Forex market is very, very lucrative. Okay, it's very, 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 very lucrative. Okay, because you can make multiple ROI on whatever you are risk on a trade. Now, there is a risk side to it as well. Okay, but the risk can be very, very well measured. Okay, so you can see somebody with leverage, B with leverage, look at the ROI, A without leverage, look at the ROI, and it's the same business. They have the same initial capital, but the other one makes use of leverage. And so that's what makes the difference. Okay. And so let's look at the example on our slide. I hope we all understood what I shared. Okay. Okay, so for example, if a trader wants to trade, let's say 5 lots, we're going to explain all of these things later, lots and all that. 5 lots means 500,000 units. Okay. It can make a deposit. Now, the thing about broker is, now the example that I painted, okay, earlier, whereby you borrow money, blah, 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 and all that. So the broker is not going to ask you for heavy collateral. They're only going to ask you for a minute fraction of that transaction value. Let's say what you want to trade when they calculated the cost of transaction. Let's say the cost of transaction is like 1 million naira. Depending on what kind of leverage you choose, the broker might ask you to drop just 10,000 naira. Look at that. They will ask you, okay, we are going to allow you to trade on this transaction that worth 1 million naira, for example, but we only need you to drop 10,000 naira. So drop 10,000 naira. That's going to be the collateral you have to pay for this trade. But there are conditions. Number one, you cannot lose more than your 10,000 naira. So they will monitor it. They will make sure that you don't lose more than that 10,000 naira, but you can make as much as you want. That is just what leverage is. Is somebody giving you money, giving you, let's say, it's an amount of money to do a business, and is monitoring it as well because there's money in it, and it's telling you that, see, you cannot lose more than this particular amount, which is a minute fraction, okay, of the money he gave to you, and it's not telling you that, but you can make as much as you want. It's very close to what the bank used to do. The bank might say, okay, we're charging you 10%, 15% interest, but if you do the business with their money, and you, let's say it's your profit is in multiples of 5 or 10, the bank will now say, they will never say, bros, they won't say drop something. No, it's like, you made too much money from our money. No, they will only ask you to pay back their money and the what? And the interest. That's it. Okay. But it's even more juicy with the brokers. All right. So that is what leverage means. In this example, the interesting part is that if a trader is right, you can make, you're going to, the profit you are going to make is going to be on the money that they borrow you. It's going to be on 1 million, not on the 20,000 that you deposit. So that's why the forex market is very lucrative. And we're going to still talk about leverage later. Okay. So you guys just have to calm down, because see, this concept of leverage, margin, and all those things, they can be confusing. And sometimes I've heard people who say, place a trade, my own money is gone. Why? Because they don't understand the principle of leverage and margin. And so they will now overtrade. Okay. They will now trade what normally their money is not enough to carry, and then they'll just blow it off. Okay. So it's very, very important that you understand, not just to jump and start trading. They want to start buying and selling and all that. So that's why before we start talking about the strategy and all that, we will make sure that, I want to make sure that every one of you, each and every one of you, understand all these things. Okay. Very, very well. They are not difficult. They are very easy and simple. But just that a lot of people, a good percentage of traders who lost their money, especially beginners, they didn't focus. Okay. They didn't learn the beginning, this kind of class. They didn't learn it very well. And so I don't want that to be your story. Okay. So let's see what we have next. Okay, now, so let's now look at the different market participants. Okay, before we go into Forex terminologies. So you might want to ask me that, why is it that this market is so big that over $5 trillion is being transacted every day? I don't know if you understand what $5 trillion is. $5 trillion every day, more than that, is the volume of transaction in the forex market. Now, the forex market is very huge. It's the biggest. So that's why one country cannot control the forex market. Okay, because there's no country in the world whose GDP is up to 5 trillion a day. All right. There's no country like that. In fact, the US, no country. Okay. So let's now look at what makes it so big. Let's look at the forex market participant. The first set of people are the central banks. Now, the central banks are very, very important to the forex market, especially the central bank of the currency that you are trading. Now, the central banks are the custodian of these currencies. They are the owner of the currency. The Central Bank of Nigeria is the owner of the naira. They might say tomorrow that they want to withdraw all the naira notes in Nigeria and pump in new ones. Okay, so they might say they want to change the look. They might say they don't want us to be spending 50 naira again. Before we used to spend 1 naira in coin, 1 naira in the paper, but they've withdrawn all those things. So the central bank own those currencies. Okay, but the central banks, the big central banks of the world, they allow their currencies to float based on demand and supply. So the central banks are very important because they formulate policies, okay, that can either increase the value of that currency or decrease the value of that currency. Okay, when we are done with the basics and all that, we're going to look at what we call fundamental analysis later in the class. Okay, where we're going to look at some of the reasons why the central banks act this way and how you can take advantage of those moves. Let me give us an example. Like since April, the dollar has been going high. In fact, since the beginning of the year, not even since last year, but since April, the dollar has been going high and high and high and high. And then one of the reasons was the one of the policies that was being introduced by the Central Bank of the United States, which is called the Federal Reserve. Okay, I don't want us to go deep into that, okay, because I don't want you to get confused. So what I'm just trying to say here is that central banks are important. So the dollar was going up like that, you just be buying the dollar against other currencies, and then you'll be making money. It's just be like you're making free money, cool money. Okay, so so that's it. The central banks, they are very, 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 very important. And then the second set of people are the institutional investors. Okay, we have people, we have the people we call the big players. Okay, so these are the people that trade. Okay, they trade this market with billions of dollars and maybe even trillions of dollars. Yes, you're talking about the banks, the commercial banks. See, all the commercial banks you see in Nigeria, they trade the forex market. They speculate too to make money. Okay, they speculate too to make money. So those your money that you put in the bank, they use them to trade. Okay, normally they're supposed to be giving out loans and all that, but they have to. They are trading with them to the extent that the central bank had to start um, pursuing them, like try to formulate a policy that there must be a percentage of the bank's saving that must be out to the economy as loans, because the essence of the banks is to give businesses loans, all right, to do to do businesses, to engage in bigger businesses so that they can do what they can employ people, because economy is all about people having jobs. When people have jobs, economy is going to get a boost, but if not, it's going to decline. All right, so that's why the central bank had to force them that if, let's say, you have $1 trillion or 1 trillion naira in your base, then a certain percentage of it must go out on loan. The reason why they are forcing them on that is that they are, if not for the central banks, they will have just loved to just be trading those money. Okay, they will just want to be trading those money. Okay, because it's actually better for them than giving them out on loan. You can give it on loan and then you start pursuing, running after the guy when they can't service their loan. Okay, so they get involved in, and then the other set of people, apart from the commercial bank, we also have the large institutions and corporations, especially all those big companies who do import and export business. Okay, and there are thousands of these multinational companies. Let me give you an example. Let's say we have Samsung or LG, electronic company, or let's say Toyota, an automobile company. Now, Toyota and let's say Samsung and all that, they don't have a plant in Nigeria. Even if they don't, even if they have plants in Nigeria, they will still have to import into Nigeria the raw materials that they will couple. Okay, which means that definitely the exchange rate of the naira and whatever currency they have in their country, let's just say the dollar, most of them the dollar. So the exchange between the naira and the dollar is going to affect their business. So let's say, like, you know, that the naira is so volatile, falling and falling and falling, it's going to make the prices of their goods to be increasing. Okay, the prices of their goods will be increasing, and so they don't want it to they don't want the price of their things to, they don't want their product to be too expensive, right? They want it to be too expensive because they want to be as competitive as possible. They're not the only Samsung or LG is not the only person doing business. So what they do is that they do what we call edge. The edge. So what a company like Samsung is going to do is, if the analysts tell them that, say, the naira is going to drop in value again, what are they going to do? Whatever naira they have, they will have to go and buy the dollar. They will buy they might buy billions of dollars in the international markets. Okay, buy billions of dollars worth of transaction in the international market. So eventually, if the naira now falls, let's say the naira gains against the dollar, or let's say the dollar gains against the naira, of course. So whatever profit they make from the market, they will now use it to offset the exchange rate risk. Okay. So once they offset it like that, it will now be that their product will now not be that expensive. So, because let me tell you, if they put the way naira is falling and all that, if they put all those burden on you, trust me, it will, the things you are buying will be far, far, far more expensive than that. So now look at hundreds and thousands of companies like this, not just in automobile, not just in technology, agriculture, retail. I mean, almost all the, you know, all the major companies, they do what we call edge. Now look at the billions of dollars of transaction from there. So you are not the only person here in this market. So we have a lot of players that are doing their thing. So number three, we have the liquidity provider. So we are getting home now. We are getting closer to ourselves. So we have the liquidity provider. So these are the people that fix the kind of make the market. They are the one that make those exchange rate that you are trading. Okay. And they're not just fixing it. They are making it based on demand and supply. So if demand is more than supply, basic economics says that the price is going to go up. And if supply is more than demand, the price is going to go down. So that means if there are more people who want to buy than people who want to sell, or there are more buying volume than selling volume, price is going to go high. There are more selling volume than buying volume, price is going to go down. So the people that manage all this up and down movement of the exchange rate based on demand and supply are the liquidity providers. So when you want to start trading, you are going to be connected to the liquidity providers through your broker. Okay, because you are a retail trader, which is number five. We're going to talk about them. Okay, so number four, we have the hedge funds. Now, the hedge funds are the guys who are trading for very, very rich people. Okay, who are trading for the people who call sophisticated investors. So these guys are managing billions of dollars or maybe even trillions of dollars. So we have so many examples of them. We have Warren Buffett. For those of you, Warren Buffett is an hedge fund manager and is one of the richest person in the world. We have Ray Dalio, is one of the richest persons in the world. We have Ray George Soros, is one of the richest persons in the world. So these guys are worth in billions of dollars because they manage funds in hundreds of billions or even in trillions of dollars. Okay. And it's not only Forex market they trade, but they also trade the other market. But Forex is one of the markets that they trade. Okay, so the last person, the last but not the least, are you and I, the retail guys. So these are the guys, they are like the small speculators, while the hedge funds are the large speculators. So they need broker. Hedge funds do not need broker because they already have enough fund to go straight to the liquidity provider, all right, to connect straight to the liquidity, market liquidity. Okay, but you don't have such fund. So you are going to need to connect through an intermediate or intermediary, which is a broker like Greenwave Exchange. So once you place an order, they will push it through to the market. And now there are now millions, tens of millions. We don't really know exactly how many forex traders we have or traders, financial market traders that we have in the world, but definitely they are in their million, maybe tens of millions, or maybe I don't know if it's up to 100 million. I don't know. So look at that number, right? So at retail trader, you can trade for as low as $5, $3. Okay. So these are different market participants. So now you have an idea of the reason why the forex market is very, very big. Okay. Okay, so now let's go and look at some terminologies. Okay, let's look at some terminologies. We already talked about base currency and the counter currency or quote currency. I say that the base currency is the first currency that appear in a currency pair. For example, Euro US dollar that we have been using is a currency pair. EUR is the symbol for euro and is the base currency. USD is the symbol for United States dollar and is the counter currency. Okay, so now we now have what we call the major currencies, which we're going to talk about when we get to the next slide. The major currencies and the major currency pairs. Okay, the major currencies are formed when the most traded appeared against the US dollar. I'm going to explain this one later. I think we need a graphical something to grab, okay, not just words. Okay, but let's just lay the definition. So when you pair the big eight, we call them the big eight, the major currencies like the United States dollar, the Japanese yen. I'm going to show us all that. When you pair them with the US dollar, it's called major currency pair. But when you pair those currencies against each other, they are called cross or minor currency pairs. Okay. Okay, maybe we should even just go there so that I won't still be repeating myself. Okay, so that we'll grab it once and for all. Now, these are the major currencies that are traded in the market. We have the euro, we have the Britain pound, that's the pound sterling. We have the Australian dollar, the New Zealand dollar, the United States dollar, the Canadian dollar, the Switzerland franc, and the Japanese yen. Now, these are their symbols, 3 letters. They're always symbolized with 3 letters. The first 2 letters represent the official language of that country. I mean, official letters of that country. Every country has an official letter. Nigeria is NG, right? Ghana is GH. South Africa is ZA. All right. Australia is AU. New Zealand is NZ. United States US. Canada is CA. Switzerland is CH. Japan is JP. Those are the official letters of those countries. And then the third letter is the first letter of the currency. Pound is the name of the currency. That's P. Okay, the country is Great Britain. Dollar is the name of the currency. D, the country is Australia. Dollar also for New Zealand. Then dollar also for the United States. Then dollar also for Canada. Franc for Switzerland. And yen for Japan. So that's what make the 3 letters that make up the symbol, okay, for each of these currencies. Okay. Now, major pairs, you get major, you know, we said that currencies are traded in pairs. Now, major pair is a combination of any of these major currencies against the United States dollar. When you pair euro, each of this one against the United States, it is called a major currency pair. Okay, United States dollar is the most important currency in the world. Okay, is the most, we call it the global currency reserve. Any country you go to in the world, you always have a reserve of the United States dollar in the with their central bank in that country, or even with their commercial bank. There's barely any bank you will get in Nigeria. They don't have US reserve. So that's why it's the most important currency, because it is one that is most traded. Okay, the most popular, the most traded, the most important. Okay, if you want to trade your oil, you trade it in dollar. If you want to trade your gold, you trade it in dollar and all that. So when you now pair the other currencies against the United States dollar, you have what we call the major currencies. But when you pair other currencies, other major currencies against themselves without the United States dollar, it is called a cross or minor pairs, like GBP AUD, like AUD NZD, like NZD CAD, like CAD CHF. Okay, and so many of them like that. By the time you complete all the permutation and all that combinations of all these currencies, you're going to get, I think, like 26, between 26 and 28 currency pairs from all of them all together. So that's a good number of markets there. Okay, and each of them is a market. Okay, so understand the major pairs and the cross pairs. Now, when it now comes to naming nomenclature, now the fact that I put euro up and all this thing up does not make that, we know we said the United States dollar is the most important currency, is the most traded, okay, followed by the euro, followed by the Japanese yen, followed by the Great Britain pound, and the rest. All right, so that's like the volume of activities on these currencies. But the way the market named them does not follow that pattern. It does not follow their strength or wherever. The way the market name them is the way I state here. So which means that euro will always be a base currency. So if I'm going to pair euro with any of these currencies, euro is always going to be a base currency. Why the other ones are going to be quote currency against the euro. I can have euro, EUR GBP, EUR AUD, EUR NZD, EUR USD, EUR CAD, EUR CHF, EUR JPY. So it's not JPY EUR. Okay. So that's why I put it as number 1 here, because of the naming nomenclature. Don't worry, you're going to get used to all those things. Now, the second one in that regard is the GBP. Now, the GBP is always going to be a major currency here, except, I mean, a base currency here, except you are pairing it with the euro. So you cannot have the GBP EUR. You can have the EUR GBP. Meanwhile, you can have GBP AUD, GBP NZD, GBP USD, GBP CAD, GBP CHF, GBP JPY. So not JPY GBP. That's not the way the market named them, or the way the naming standard. Okay. The next online on this in this regard is AUD. So AUD is going to be a base currency against all this one, except Euro and GBP. Next one is New Zealand dollar, and it's going to be a base currency against these four, apart from the three above. USD is going to be the next one. It's going to be a base currency against all this one, apart from above. Also, it's going to be a base currency against a currency like Nigerian Naira. So you are not going to have NGN USD. You're going to have USD NGN. And for Canada also, it's going to be a base currency to only this and this, while it's going to be a counter or quote currency to the other ones. Just that's it. Okay. Okay. So that's it. Wow. So do you guys understand major currencies, major pairs, and cross pairs, and the naming nomenclature that I just explained now? If you understand, please drop yes for me. Drop yes if you understand it well. I want to get yes from at least 5 people before we continue. So let's just be doing it, gradually like this. Don't worry, we're going to get to, we're going to get what we want to get. See, we're going to get what we want to. So I've only gotten how many yeses now? 1, 2, only 3 yeses. I've gotten only 3 yeses. I want more yeses, please. Okay. Okay, the yeses, thank you. Mimi, thank you. Father Ray, thank you. Bolan, Essien, Kadri, Lanre. Okay, cool. So let's just continue. Now, let me give you an example. Let me see how many people are going to get it well. Let's say that I want to pair CAD. I mean, let me say, okay, let's say I want to pair this one and this one. What is going to be the name of that currency pair? I want to pair this currency and this currency. What is going to be the name of that currency pair? Please write only the symbol. Okay, let's go. That's the first exercise for you guys. Very simple. Oh, fantastic. Good. Oh, good. Thank you, guys. So let me give us another one. Let me give us another one. So let's say I want to pair JPY and CHF. As I want to pair JPY and CHF. How is it going to be like? How is it going to be like? Okay, Quadri says CHF, JPY, CHF, JPY. Okay, fantastic. That's good, guys. That's good. Thank you very much. So that means we are cool. No, so I've done it. I have to say, okay, yeah, I've done a fantastic job myself for giving you this. Because oftentimes when we just train people like this, they will start asking, why did you put this one as the first? Because when I'm giving you example, I will say at some point, I will say euro, US dollar. When I want to give you another example, I will say US dollar, CAD. And then you did ask me, what makes US dollar to be the counter here and the base here? Okay. I get that question every day. That's why I say, okay, I have to just make sure that I explain this thing. Okay. So that I won't get that question again. And so that's good. Let me say that's good of me. Okay. So that makes the work to be easier for us. So we all know. So it's just all about naming. All right. The normal standard naming. Okay, now, so let's go back. Now, apart from the major pairs and the cross pairs, we also have what we call exotic. Exotic. Now, we say that we have 8. These are the major currencies, 8 in number, okay, that make up these majors and cross. Now, that's not the only currency that can be traded. These are not the only currencies that can be traded. We have other currencies that can be traded. Okay, like the currencies of some of the emerging markets. These ones are considered to be advanced places. Okay, while those ones are emerging. Okay, but that's just I think that's just an old style of saying that. So, but let's say exotic are those ones that are not here. But let me say the best way I like putting it is that these ones are the reason why they are the major currencies. It's not because they are from the major economies. All right. It's because they are the most traded. Do you get it? They are the most traded in terms of volume. Now, those ones that are not that as much as traded as this, they are called exotic. Okay. Mary has a question. Please drop your question. Type it. Type your question, please. Okay. Those currencies that are not here, that means they are not as voluminous, they are not as engaging as these ones. They are called exotic. Like your Nigerian naira is an exotic currency. Okay. Like the South African rand, that's the ZAR, is an exotic currency. The let's say Singaporean dollar is an exotic currency. The Norwegian krone, NOK, is an exotic currency. Okay. Um, there are just so many of them like that. Hong Kong dollar is an exotic currency. Okay, so you have Mexican peso and all that. So these are exotic currencies. Now, when you now pair any of these exotic currency, or let's say when you have a pair and one of them is not a major currency, when you have a currency pair and one of them, at least one of them, either one of them or the two of them are not major currencies. So that pair is an exotic pair. Okay, that pair is an exotic pair. Okay, somebody said, what's the one for Russian ruble? I think Russian ruble is RUB. I'm not sure. I'm not sure because I don't trade it. So I think it's RUB or something. I think it's RUB, something like that. Um, okay, so when you have your exotic is when you have a currency in a currency pair, when one or two of them is not a major currency, then it's an exotic. Now let's look at some examples. Maybe I should ask you guys to even give me an example. Let me see if somebody can give me an example of an exotic pair. Okay, let me see if somebody can give me example of an exotic pair so that I will know if I explained well or not. Okay, so I just need one person to give me that, or let's say two. Okay, I have NGNZAR. Cool. That's Nigerian Naira and South African Rand. Or the South African Rand may come first. I don't, depends on how they do the nomenclature because now these ones are not traded. All right. It's not a traded currency, but yeah, but it's an exotic. Now, somebody give me a very good example, which is GBP and MXN. MXN should be Mexican peso, right? Mexican peso. Let me look for the symbol for Mexican peso. No, I don't trade it, so I won't be able to have it all offhand. I want to see if it is MXN. Mexican peso. Okay, symbol. I think it should be MX or something. I don't know. Not sure. Let me find out. Okay, MXN. Okay, that's Mary is actually right. MXN, that's the Mexican peso. Beautiful. And then Larry says Hong Kong dollar and NGN Nigeria. Please let's not use Nigerian naira. Okay. Let's not look like you. Let's just pair an exotic with any of these other major. Now, okay, an exotic currency against this. Okay. So those are actually better. Don't even do exotic. Just do exotic and a major. Okay, because exotic and exotic are not that they're not trade. Nobody trades them, honestly. Okay, because it's all about volume. It's all about people's willingness to trade them. So If anyone want to trade an exotic, why would you want to trade exotic against exotic? You could actually trade exotic against these ones because it's all about acceptability. If you say you want to buy and then you now want to sell back, who will buy back from you if it's not something anybody wants? Okay. Somebody gave me a very beautiful example. That's SCN says USD NOK. Beautiful. That's the US dollar and the Norwegian krone. Nice. Quadri also gave me a very, very good example. CAD NOK. That's the Canadian dollar and Norwegian krone. Okay. In fact, the most popular exotics are the ones that appeared against the dollar. Okay. Like USD Singaporean dollar, USD Norwegian krone, USD Hong Kong dollar, and USD South African rand, USD Mexican peso, and all that. Okay, guys, thank you very much. Let's move on. We don't have much time left. So let me clean off. Okay, I can actually do it like this. Okay, guys, so let me go back to the previous slide so that I would see. No. Okay. Okay, so we've talked about the major currency pairs and all that now. So I don't need to talk about them again. Okay, so we now let's move to what we call the bid price and the ask price. Now, when you go to the bureau de change, like what we said earlier, we said there is always the buying price and the selling price for you and for the exchanger. Your own buying price is the exchanger's selling price, while your own selling price is your own exchanger's buying price. So when we define these two terms, it depends on who you are referring to. So the bid price is the price a trader is willing to sell. Or it's not that you are willing to sell actually, because you're not the one that is, they will give it to you. And if you want, cool. So let's say is the price a broker is willing to buy. So if you want to sell, the bid price is the price the broker is willing to buy. Okay. Why a particular currency pair is the price a broker is willing to buy a particular currency pair. That's the bid price. Okay. We can also call it the buying price. Why the ask price is the price the broker is willing to sell. So that's the own buying price, right? But it's the broker's selling price. So that's the selling price. So we're going to be looking at it from the broker's perspective because we are traders. Okay. So the ask price is the selling price. That's the price the broker wants to sell to you. Why the bid price is the buying price. That's the price the broker wants to buy from you. So which one do you think is going to be bigger? Because the broker will have to make money, right? Which one do you think will be bigger? Don't say buy price or selling price. Just tell me if it is bid price or ask price. Which one do you think is going to be bigger? Is it the bid price or the ask price? Now let me see comments. Which one do you think is going to be bigger? Is it the bid price or the ask price? Okay, Larry said the bid price. Mary also says the bid price is going to be bigger. Mimi says the ask price. Okay, so we are getting different answers. So Yusuf says bid price. I want everybody to write the answer because now that we have different, so we have Quadri say the ask price. If you can change your mind though, anybody can. So Father says it's the ask price. And SN says it's the bid price. Okay, I think that's enough. Now, the one that will be bigger is the ask price because that's the price the broker is selling. Remember what we said at that time that when you go to the bureau de change, it sells at a higher price than it's buying. So the ask price is always going to be bigger than the bid price. Okay, do you agree with me? Those that says bid, do you agree with me that the ask is going to be bigger? Yeah, the ask is going to be bigger because that's the price, that's the selling price, the exchanger's selling price. You go to the bureau de change. Let's use the bureau de change example again. Okay, let's use the bureau de change example again. You go to the bureau de change now is like the broker. They are the broker. You go to them. It's telling you he has the price is selling and the price is buying. Definitely the price is buying, is selling. It will be more than the price is buying so that I can make profit. Okay. If it's selling for 500 naira, it's going to buy less than that. Say if it buys 495 and sell higher than that, it's just like every business now. Your selling price is always going to be higher than your buying price. Okay, you go to the market as a business person to buy whatever the thing that you sell. Definitely, when you want to sell, you add something on top. All right, so that's going to be your profit. It's the same thing here for the broker. The ask price, which is their selling price, is going to be bigger than the bid price, which is their buying price. Do you agree now? Okay, Mary, do you agree? Okay, Larry says yes. Do you guys agree? SN, Yusuf, Larry, do you guys agree? If you agree, please let me know. Okay, Mary agrees. Okay. So now the difference, or let's say the profits, is going to be the difference between the ask price and the bid price, just like the normal thing, right? Now, but there's a name we call that. That is called the spread. The spread is the difference between the ask price and the bid price. So the spread now is the profit that the broker makes. Now, when you start trading on the green wave exchange, because some of you will ask, this guy has been teaching us since yesterday, he's been shouting and talking and all that, and the green wave exchange is saying it's going to be free and all that for 2 weeks, a class that can worth us, I mean, a lot of money, okay, can work what a very good amount of money if the trainer is going to charge us, but it's doing it for free. What is their own gain? The gain there is spread. When you start trading on the platform, on the green wave exchange platform, Green is going to start making money from spread when you come to buy from them and when you sell, when you buy and when you sell different instruments. Okay, so that's how they make their own money. The profit is very, 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 very tiny, small, 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 which you're going to understand later. But that's why it is important that the broker get a lot of people trading on their platform. Okay, so it's a game of number for them. It's a game of volume. It's a business of volume. It's a business of number. The more people that trade on their platform, the more they make money from spread. Okay, so if you know how to trade very well, you make your profits because Green Wave Exchange connect to the liquidity provider. So your profit comes from the liquidity provider. If you lose money to it, goes to the liquidity provider. So that's why it's important to give you enough training so that if you are making money, you continue to trade and Green Wave continue to get their own money in spread. You continue to make your money and keep it. Okay, so that's why you need to be a successful trader. That would be a win-win situation. Okay, so let's go on. Now, this is how it looks on the trading platform. These are the different currency pairs. You can see them. That's how you see them on the trading platform. Okay, this is the price. This is the US dollar against the Japanese. This is the bid price. This is the ask. You can see that the bid price, the ask is more by 1.4. This is 1 point. We're going to explain all of these things later. This one is in decimal place, one decimal place. This is 1.4. We call it PEEP. 1.4 pips, 1.7 pips. You can see the spreads are different for different currencies. Australian dollar is 1.3 pips, 1.4, 1.4, 1.9. This one, I prepared this slide. I used this example as the one of maybe, it's never from Greenwave actually. Okay, it's the one that I prepared like 3 years ago or so. So that's why I just use it. Okay. So this is not the actual spread at the moment. They're actually smaller than this. Okay. So this is the spread. Okay. Which is the difference between the ask price and the bid. And you can see that the ask price is for all of them is bigger than the bid price. Okay. Now there's another fee that traders pay when they trade. And that's what we call the swap or rollover fee. Okay, for those of you who will be carrying trades over to the second day, okay, you can collect a swap fee or you can be paid a swap fee. Okay, because when you start trading now, you will start seeing those things so that you won't be surprised. Now, when a trader keeps a trade overnight, is expected to receive or pay a rollover fee or swap. A forex swap is the interest rate differential between the two currencies that you make up the pair being traded. So what we're trying to say is that when you trade a currency pair, you are trading two currencies at the same time. That's actually what it means. Okay, you don't really need to bother about how you are trading two currencies at the same time, but you are trading two currencies at the same time. And when you take those trades to the following day, you are going to pay interest, okay, or you are going to be paid interest. For example, if you buy euro US dollar, for example, okay, if you buy, don't worry, this is not a complicated thing. If you don't get it right now, you're going to get it later. So this is euro US dollar currency pair. Let's say you buy it. When you buy euro US dollar, what you are trying to do is that you are buying euro US dollar and simultaneously selling US dollar. Sorry, you are buying euro and simultaneously selling dollar. That's what it means. When you sell, it means you are selling euro and simultaneously buying US dollar. Now, let's say you're buying, if you buy the euro, if you buy the euro, you are going to be paid an interest rate, an interest. Okay, you are going to be paid an interest. And if you sell the dollar, you are going to pay an interest. So this one you are going to be paid, this one you are going to pay. Now, if the interest rate in the Eurozone is, let's say, 0.5%, and the interest rate in the United States is, let's say, 0.75%, you can see the difference now. Here, you will have to pay 0.75, and then you have to be paid this. So the differential is going to be minus 0.25%. Okay. But if you had sold, this minus will have been positive. So that's what I'm just trying to say here is that your rollover can be positive and it can be negative, but trust me, it's very, very minute. Okay, it's very, very minute. We don't really need to discuss so much about it, and it's only applicable when you carry a trade overnight. Okay, me, I carry my trade overnight. It could even be 2, 3, 4, 5 nights. Maybe sometimes there are some trades that are open for weeks. Okay, but we're going to look at different types of traders later. Okay, what will inform your decision, okay, concerning the time frame, the time frame of your, or the duration of your trades, whether you're going to open trade today and close it today, or hold it for a few days or a few weeks or stuff like that. So that is going to be later. Okay, so we've talked about swap. Now, this is the formula for swap. Like I said, you don't really need to bother yourself about it. We'll have bothered about it if it's a big number, but it's a really, really very small number. Okay, so, but that's what when you see it being deducted or being added to you, depending on what the differential, interest rate differential of the countries of the currency you are trading, whatever it may be. So it's just for you to know that, okay, that is swap or rollover. All right. So let's look at one more concept before we finish for today, and I'm going to take your question. All right. So let's look at the currency codes and rates. In the Forex market, the exchange rate of a currency pair is in 5 decimal places. Like the example I was given on Euro US dollar and all that. Normally it's in 5 decimal places for all of the currency pairs, apart from those currency pairs that, I mean, Japanese yen currency pairs. Okay, you know, Japanese yen is at the bottom of the nomenclature. So that means Japanese yen is always going to be a counter currency, a quote currency. So all those currencies that have Japanese yen as their counter currency, they have 3 decimal places. Okay, their currency pairs are named in 3 decimal places. Why the other one in 5 decimal places? Okay, let me give you examples of what I'm talking about. Okay, look at it here. So you can see the Japanese yen here, the one that ends with Japanese yen, this one, and this one, and this one, and this GBP Japanese yen, CAD Japanese yen, Euro Japanese yen, US dollar Japanese yen, CHF Japanese. You can see that they are in 3 decimal places. Can you see them? 3 decimal places. 3 decimal places, both the bid and the ask price. Even this one, 3 decimal places. That's what I'm trying to say. Okay, but those ones, other ones are 5. USD Canadian dollar, I can see 5. Euro GBP 5, 5, 5, 5, and all that. It's only those ones that end with JPY that are 3 decimal places. I hope you understand that now. Cool. So let's now go to the explanation better. So Now, if the exchange rate of GBP US dollar is equal to 1.234, what that means is that 1 unit of GBP is equal to $1.23451. That's what it means. And that is called exchange rate, or the rate, or quote. This together is called the quote, while this one is the exchange rate. And that is what you are trading. You are trading these numbers. Okay, this number is what you're trading. When they go up and you buy, you make money. When they go down and you sell and they are going down, you make money. But if you buy them expecting it to go up and it goes down, you're going to lose money. And if you sell them expecting them to go down, sell it and expect it to go down, these numbers to go down and it goes up, you're going to lose money. Okay, so you have to get the direction right. That's why you need to learn a method of analysis, analyzing the markets. Okay, so that is it. 1.23451 is just an example. The difference between an old rate and the new rate is measured in pips. Okay, because definitely you have to have a way that you measure this market, this exchange rate when they are changing. Okay, like there is a particular price the market opened today, the GBP US dollar market opened today, and there is a price is going to open for today. You can measure the difference between those two prices, and that measurement is in pips. Okay, pips is the SI unit of the currency market. That is the standard of measurement. Just like you have kilogram for weight. You want to measure your weight, I weigh 5 kg, or you're looking at length, is 15 kilometers, or you're looking at speed and all those things. It's just a way of measuring time, seconds, minutes, hours, and all that. We have for the Forex market pips. Okay, pips is the way we measure the Forex market movement. And we're going to talk about it extensively. We're just still defining it, okay? So don't disturb yourself at all. So a pip is the smallest price move that an exchange rate can make based on Forex market convention. And the pip start from the 4 decimal places. You start your pip counting from here, okay? Leaving the last one. So that means the last one is not up to 1 pip. If it is 1, that's 0.1 pip. If it is 2, that's 0.2 pip. If it is 3, that's whatever, that's 0.3 pip and all that. So the pip start from here, like this 5 pip. This one is like 40 pips, then 45 pips, 345 pips, 2,345 pips, 12,345 pips. This is not up to 1 pip. Okay, and we're going to talk about that when we look at pips very well in the next class. Okay, so, but what do we now call these ones that are now up to 1 pip? We call them pipettes. Pipettes are a movement of the 5th decimal place of most FXPS code and the 3rd decimal place of JPYPS. For JPYPS, pip movements start counting from the 2nd decimal place, okay? While the 3rd decimal place is not up to 1 pip, so it's in pipette, okay? So we're going to talk about all that later in detail. And so that is going to be the end of today's class. I hope you guys enjoy today's class. Now it's time for question and answer. So please ask your question now, all right? And this is my email address. If you have any question, let's say you don't remember it now, you can always send it to this email and I'm going to respond to you. Okay, so type your question. I'm going to respond to you. So do you have any question now? So I will have to stop this meeting now so that I can then take your questions.